This topic is pretty timely, and I've done a version of this in years past. This is all about how you can use your IRA to meet your charitable intent and lower your taxes under the new tax law. So the new tax law has thrown some of the old practices out the window. And it's kind of forced people to think about how to best utilize their IRA and really to retain their tax deduction for charitable giving. And I'm going to kind of go through a little bit of how the tax law changed. I'm going to talk about what a charitable contribution from your IRA really means. I'm going to give you an example to kind of show you the type of tax savings that you can gain by using your IRA as a charitable tool. And then I'm going to talk about other ways in which you can give if you don't qualify for giving a charitable contribution through your IRA. Because there are qualifications, there's eligibility, and it's all based on your age. And when I say it's timely, the tax law just changed on December 20th. The president signed a bill called the Secure Act, and I had talked about the Secure Act many months ago, and I wrote about it because it was a really unique lawmaking exercise. The House, back in the summer of 2019, so 8 months ago, they passed a bill. Now remember what we're talking about here. We're talking about the House of Representatives in D.C. with Democrats and Republicans in this political environment where, frankly, I would say it's probably the most divisive environment politically that we probably all can remember. I think that's pretty safe to say. They passed a bill, the House did, with a vote of 417 to 3. So this was a nearly unanimous vote for a bill. And this is a bill that was designed, in many ways, it's designed to enhance retirement savings and try to create tools for people to be able to save for their retirement more effectively. So I think they all recognize that there's probably a retirement crisis looming in this country, and this bill is aimed to try to create certain changes to help that. But 417 to 3. And then it went to the Senate, and it sat there. It sat there for months and months and months and months, and there's some small little esoteric lawmaking tricks that can happen. And a few senators said, we're putting it on pause. It was designed to get to the Senate and then be passed immediately with no changes. So unlike the normal bill making process, which is you pass it in the House, you pass something in the Senate that's similar, that you then go to a conference and reconcile the differences, and then re-vote in the House and re-vote in the Senate, and then send it to the President. That's normal. This was pass it in the House, intended to be passed as is in the Senate, fast-tracking it right to the President to sign. Because 417 to 3 tells you something. So it went to the Senate and sat there for, I think, political game-making kind of purposes for a few senators. They wanted something else, probably completely unrelated, to happen. So they held it up, and they thought they had leverage. It sat there and sat there and sat there. And so I wrote an article saying, I wonder if it's ever going to change. It ended up being added to a spending bill in late December, which was required essentially, and it had enough momentum to be able to just be tacked on as an amendment essentially to the spending bill, and it passed the House, passed the Senate, and was signed by the President all within a flash of time. So the big change, and this is the timely aspect of it, is that all of this talk that I've ever done and that everyone ever does on the idea of a required minimum distribution age of 70 and a half. Does that ring a bell to this group? Okay. So they changed that for people who didn't turn 70 and a half before the end of 2019. So effectively that means anybody who was born July 1st, 1949 or after, they're going to operate under a completely different rule, and that is that 72 is the age. So how many of you fit that bill? July 1 of 1949 and after. Okay, and then everybody else, of course, is before. So anyone before that date, still operates under the required minimum distribution age of 70 and a half. Everyone after that date now has a new rule, which is 72. This tool, a charitable IRA, making charitable contributions directly from your IRA, used to be tied to the exact same age as the required minimum distribution of 70 and a half. So the only way that anyone can ever use their IRA as a charitable tool, and we'll talk about why anyone would want to do that as we go through the presentation, but anyone who was 70 and a half, literally has reached 70 and a half, can make contributions directly out of their IRA to charities. And that money that you give is not taxable income. In fact, the government says, you know what, we'll count that as part of your distribution to meet your required minimum amount that you have to do every single year. So theoretically, a person can write checks and satisfy their complete required minimum distribution. The government says, great, you met your distribution and we won't count any of it as income to you. So that's the way that it worked. But you had to be 70 and a half. And for everybody in the country, it's still 70 and a half. It's just that at the same time, 70 and a half happened to also be the required minimum distribution age, where you had to take out your required distribution by 70 and a half. And now there are some people where that's still the case, and some people now it's 72. But everybody still gets to do charitable distributions from their IRA once they hit 70 and a half. So they've created what I think is another level of complexity. And for people who are in the business of money, we're talking about accountants, we're talking about investment advisors, complexity is probably, well, we don't mind it because it helps us have something to say. But for tax law purposes, I think that they probably should not create so many oddball age deadlines or age triggers. And they've now created this new one for people who are July 1, 1949 and after. So that kind of gives you an idea of the timeliness of it. But this whole conversation is going to be about charitable IRA contributions and why you should really think about setting yourself up for those of you who've hit 70 and a half, why you should set up the mechanics of your life to allow you to give contributions directly from your IRA. So let's first talk about the big changes that actually happened in the tax law. There are many changes that happened in 2017, the end of 2017, a tax law change happened, and the first year that it was in effect was 2018. And so now we've gone through the second full tax year. So, and there are still these planning tricks that my industry is still teaching the public, and same thing with accountants and tax preparers. It takes a little time for people to figure out what changes have happened and how we can take advantage of it. So the biggest change is that we have a situation where itemized deductions have changed in how we actually can take itemized deductions. And the standard deduction was doubled. So just for breathing, the government decides that you can immediately subtract a certain portion of your income from the tax calculation, just by being a living person. So the standard deduction doubled, and the itemized deductions, the other comparison, essentially you decide, am I going to itemize my deductions or am I going to take a standard deduction? The itemized deductions have been minimized, kind of hampered, diminished, and I'll show you how. And the standard deduction, on the other hand, has been doubled. So we can all see what has happened, what happens when that kind of change occurs. People who once itemized will now and have been filing as standard deduction filers. That is a simplification of a kind of a large way. I mean, before you had to keep track of all your itemized deductions, and we'll go through what those are. Now, a huge portion of people who once itemized are now doing a standard deduction. You don't keep track of any of it. So you have a lot less record keeping to do as a taxpayer. So that really was, I think, a huge benefit of the tax change, but it's had implications. So this gives you the idea of that doubling. back in 2017, let's kind of talk about a single person. Your standard deduction was $6,350. So simply for breathing, you were reducing your taxable income by $6,350. You may have had an easy time looking at your itemized deductions and thought, you know, I had medical expenses, I had mortgage interest, I had property taxes. We'll go through all of these, but I add up all of those, including my charitable donations, and I can easily leap over $6,350. I'm going to be an itemized filer. But now it's doubled, close to doubled, $12,200. That was back in 2019. This number now is $12,400. It goes up with an inflation rate. The government adjusts it. This becomes harder for your itemized deductions to leap over. And if you go to a couple married filing jointly, $12,700 is now $24,400. Actually, it's $24,800 now. So that's quite a huge jump for a married filing jointly situation. So this has kind of shifted the number of people, and I don't know the exact number. I always kind of quote numbers because I have it in my memory. But I think that somewhere around 30 to 35% of all taxpayers used to itemize their deductions. And now it's somewhere around 10%. So it really has made it so that 9 out of 10 people are now doing the standard deduction over itemized deductions. That is a simplification of pretty big proportion. So let's go through the changes to the itemized deductions. So I guess what I wanted to make sure that we all understood is itemized deductions versus standard deduction. That's just something that you look at when you're filing your taxes. As I said, they took the itemized deductions and they really diminished it, hampered it. It's almost like they said, let's get in a foot race, itemized deductions versus standard deductions, but we're going to tie a big cinder block to the itemized deduction runner and let's see how it turns out. They really have lowered the itemized deductions for some people. And let me talk about what the categories are and kind of what the limitations are. So first off, health expenses, out-of-pocket medical expenses. That's at the very top of Schedule A. So when a person itemizes, they have Schedule A, and at the very top of it is out-of-pocket medical expenses. There is a limitation that's always existed, and it basically says this. You might have medical expenses, out-of-pocket medical expenses. You can add them all up, but we're going to compare that to your income, and we're going to put a threshold before we're going to allow you to take any deduction for those expenses. The threshold is 7.5% of your adjusted gross income. So all your income added up, the first 7.5% of that creates a portion that you have to leap over that with medical expenses to have it count. So very simple example, a household, $100,000 of adjusted gross income, 7.5% threshold is applied to this. So $7,500 is the threshold, and you might have $8,000 worth of medical expenses, out-of-pocket medical expenses. So $8,000, compare it to $7,500, and the government says, fine, on Schedule A, you can put $500 of deductible medical expenses. So this has a limitation. I will tell you that that spending bill that they tacked the Secure Act onto, it actually changed what was going to become a 10% threshold. They brought it back to 7.5%. So it was slated to actually rise, which was going to effectively minimize the amount of deductible expense for healthcare, for out-of-pocket medical expenses. But then they struck that and said, let's keep it at 7.5%. And they do all of this stuff at the very end of the year, and they've always done it. It's called a tax extenders bill. And so they always give these little sweeteners, and every year people wonder if it's going to happen. And then every year they sign a bill and they keep the sweeteners in the tax law. So the next one is a really big change. This is property taxes and your state income taxes. So those are deductible. If you're going to itemize, those are deductible. It used to be unlimited. So you could own 2 homes, in a very expensive area with high property taxes, and you might have a lot of deductible property taxes. You might be a high income earner and you have to pay a lot of state income taxes. Those were deductible fully. The tax law changed it and said, $10,000, that's the most that we're going to let you deduct from those categories. That is a very big change, especially for states like New Jersey, for states like California. High property value, high property tax states, high income tax rates. So this was a very controversial part of the change of the tax law, and it happened to hit Democrat-controlled states, and so I don't think the Republicans really cared too much that it was hurting those voters. But that's me being skeptical. So $10,000 is now the cap. So that you can see how that's really tied a cinder block around itemized deductions for some people. It's really weighed down how much you can itemize. And then, of course, they've kept mortgage interest. Mortgage interest is still deductible. They made some small changes as to how that works, but it's not worth delving into. And then finally, charitable donations. So charitable donations are also on that list of itemized expenses. So those are the four big things. They got rid of other itemized expenses, deductible expenses, things like job move, various other things like I think teachers paying for school supplies was once deductible, no longer. Tax preparation fees used to be a deductible expense, no longer. Investment advisory fees on taxable accounts, no longer deductible. So those were things that actually did reduce itemized deductions even further. So let's talk about so you can see the dynamic that's happened. Itemized deductions are now lower because of limitations and the elimination of certain things, and standard deduction doubled. So we all know now that a large portion of taxpayers have moved into a standard deduction filing situation. Simpler, but it has implications, and here are some to think about. Think about this glass of water with all of your deductions, and you start to pile in and fill up all of your deductions as itemized deductions outside of your charitable giving. And it adds up to here, halfway up the glass, let's say. To that, we can add charitable donations that we just make from our regular old checking account. Write a check from your normal bank, not your IRA, you're making it from your normal bank. And if you can fill up that glass all the way up, we have to compare it to what would it have been had we just had the standard deduction. Because you're already by default allowed to fill up the complete glass to the standard deduction level. So you can imagine that a person who's giving donations in this new tax law, where all their other itemized deductions don't fill up the glass, and then they do charitable donations out of their checkbook. And then when they go to file their taxes, their tax preparer says, well, all those donations that you gave didn't change your taxes in one iota. You thought that they were deductible. Normally they had been. Now your standard deduction was going to supersede everything anyway. So all those donations you gave didn't lower your tax bill from what it otherwise would have been. So in a way, it creates a situation where you're wasting the tax deduction for your charitable giving if you're writing it directly out of your checkbook. And this is true. And there's only a couple ways really of getting around it when you're under 70 and a half. But when you're over 70 and a half, you've got the tool to make it so you don't have to waste those deductions the way that the way this diagram shows it. When you're over 70 and a half, the government forces you to take out a required distribution, and you can use your IRA to give various levels of donations directly out of your IRA, and the government says, great, you're satisfying with each one of these donations, you're satisfying your required distribution. And we're not going to count those checks going off to Father Fred and to various other entities that you support. We're not going to count that as income to you. That is essentially lowering your taxes, and we're going to go through an example of it as we go along. I want to make sure that this diagram here makes sense to you. You have itemized deductions. It doesn't fill up the glass. You're making charitable donations that add to the level of this water in the glass, but you were going to get a full glass under your standard deduction situation. Crystal clear? Okay. So here's the new diagram. You're 70 and a half. You have to take out required minimum distributions. Government's forcing that, except for people now, July 1, 1949 and after. You're 72, but you still get to do this. So that's the small complication that they added. Here are, if you think about what you're dealing with here, you've got a situation where you have a taxable required distribution. When you take money out of your IRA and you live off of it, you spend it on things that are normal part of your life. Feeding the dog, eating food, going on vacations, going to the doctor, paying for your household expenses. That portion of the money that lands in your checkbook and you go ahead and spend it on things that matter to you, that you sustain your living, that will be taxable. But when you take money out of your IRA by writing a check or calling your brokerage firm and having them send it directly to the charity, there are multiple ways of doing it, and we'll go through a couple of those things. That portion of the stuff that comes out of your IRA is considered non-taxable or a tax-free distribution out of your IRA, but it satisfies the total required distribution. The ways in which you can get money out of your IRA and actually send it to charity and have it count is, first off, it has to be a qualified charity. 501c3s. It can't be your brother-in-law. It can't be somebody who's really in need, that you find a needy person in your life and you want to support them. Those are not qualified charities. But if you give money to a qualified charity, it counts. And I'm not going to get into the specifics of what those qualified charities are, but my recommendation is that when you give money, you make sure you're giving it to somebody who is running a qualified charity. Churches, for example, count. You just ask those people what their tax status is, and they'll provide that information to you. You can call the custodian who holds your IRA. Might be a Vanguard or a Schwab or a Fidelity or a Merrill Lynch or whoever. You can call your advisor if that's your contact point. And you can have that entity, that custodian, send the money directly to the charity. Oftentimes they'll want to send that check to you, written out to the charity, and then you forward it on to the charity. Because in the end, I want you to know that keeping track of where you're giving the money and having verified proof that you gave it is important, because the government can, the IRS can audit you and say, listen, I saw that $20,000 came out of your IRA. You said that $5,000 of it went to charity. All we see on this thing called a Form 1099-R, which is the distribution report that says money came out of your IRA, all we see is that $20,000 came out of your IRA. But you're saying that $5,000 went to a charity. I'd like to see verified proof that $5,000 went to charity. Because you're going to put down $20,000 came out of my IRA, but we're going to subtract $5,000 of it because we gave it to charity. So if you say it, you have to prove it. So I think a lot of times brokerage firms want to at least send you the check before you forward it on, or they can provide for you. It's not every single brokerage firm that allows this, but I called Vanguard because I did get a recommendation from a suggestion from an attendee at the last time I did this program to call Vanguard because they thought this didn't exist, but I think it does. I feel it does now. They can give you a checkbook that's attached directly to your IRA. So consider it like your IRA checkbook. You can write the check to the charity and send it along and just keep a copy of it. You'll also be able to see, for example, at Schwab, we can actually see a check image for every single check you've ever sent out. And we know it went to a charity because it has the name of the charity on the check. So a check image is important too. So the big caveat here that I want to make sure you're paying attention to is no matter how you're giving it to the charity, either directly through the custodian or writing your own check. So you just call the custodian and ask them for a checkbook on your IRA. Remember, it's only for donations. No taxes are withheld from it because it's not taxable income to you. So normally you take money out of an IRA, you think, well, I wonder how much I should withhold for taxes. Well, when you're giving it to Father Fred, you know it's not going to be taxed. It's not going to be taxable income to you, so you don't have to withhold anything to it or from it. So the 1099-R, I want to just make sure it's very, very clear. The 1099-R, the report that the government gets that says $20,000 came out of your IRA, it does not subtract your charitable giving from that. And that can be a huge mistake, because if you don't talk to your tax preparer or you forget that you gave away $5,000 to charity, what's going to happen? You're going to put on your tax form that you had $20,000 of distributions from your IRA, and that's all taxable income, and you're not going to get the benefit of having given away $5,000 to a charity. That's a really important point. And I believe the reason for it is that the Schwabs of the world, the Vanguards of the world, the Fidelities of the world, they're not in the business of verifying whether you actually gave it to a qualified charity. Why would they want to be in the situation of saying, yeah, government, they didn't take out 20, they took out 15 because 5,000 of it was to a qualified charity that we're not verifying. So who's on the hook then for the mistake when you gave it to the brother-in-law or to the next door neighbor to help them out? And you thought, well, that's charitable, which it is. It's just not deductible. And the government and Schwab and Vanguard don't want to be in that business of verifying that. So I get it. It's just that I can tell you people over the age of 70 and a half, as they advance in age, the details of keeping track of this, especially near the times when you might be cognitively challenged at some point and you've gotten very habitual about writing checks to charities, it can very easily slip your mind when you talk to your tax preparer to say, oh yeah, by the way. So, I think the lesson there is have a good relationship with a tax preparer who knows your habits. Those are important things. Or keep very good records and communicate that and write nice notes to yourself from year to year. Okay, so this whole slide is to just simply say that the stuff you use out of your IRA for your own self, that's going to be taxable. Anything that you're giving away from your IRA is going to help you meet your required distribution without having any taxation on that portion. So I put this next slide up to talk to you a little bit about, and I don't want to belabor the point here because I've got a couple of examples to go through, but I want you to know that one of the benefits of using some of your required distribution towards charitable giving is it lowers the amount of taxable income coming out of your IRA. Is that clear that the portion going off is not going to be taxed, therefore your overall income is going to be lower? The benefit that can show up for a lot of people is if they lower their IRA distributions that they live off of and therefore pay tax on, it can actually have, and I'm going to show an example, it can actually have a positive benefit in how much of your Social Security is actually being taxed. Because the way Social Security taxation works is it says if you don't make a lot of money, we might not tax any of it. It'll be a zero. But if you start making more money from other sources, dividends, interest, capital gains, IRA distributions, pension income, rental income. We can go on and on and on of different ways that you can make money when you're retired, even working after the age of 70 and a half, for example. The more that you make, the more they can tax. And by the time you get to somewhere in the range of $35,000 to $45,000 of counted income, the technical term of it is called provisional income, and it actually includes part of your Social Security inside that calculation, interestingly. Once you start reaching those thresholds, it moves from zero taxed up to a maximum of 85% taxed. And it goes from 0 to 85 in somewhat of a gradual fashion. If you lower your overall income from your IRA, that might actually lower the amount of Social Security that gets taxed. So you get a kind of a double bang for your buck. Does this make sense? It's kind of a dual benefit. Lower IRA income, great. Lower Social Security tax. I don't have to pay tax on a portion of my Social Security. Wow, that's really great. So this kind of effect of using your IRA for charitable donations can actually have this kind of double whammy effect in lowering your taxes, and I will show that to you. Part B is part of Medicare, and this is an example of people who have pretty high income. They're very fortunate. They've got high income in retirement. The downside of having high income in retirement is that you actually have to pay more. If you've passed certain thresholds, pay more for your Part B premium from your Social Security check. So the standard amount right now is about $145 per month from your Social Security for Part B coverage. And it's just deducted right out of your Social Security check, so you might not even notice it. If you go above certain levels of income, and I'll give you a couple round numbers, 75,000 or so of income for a single person. Once you go above that, the government tax on another $50 or so per month. So $600 a year of more premium simply because you have higher income. For a married couple, 170,000, right around 170,000. That's the point where you start to pay your extra, and they call it a surcharge. It's an income-related Medicare something adjustment. But I go by the surcharge, the Medicare Part B surcharge. And it gets even higher and higher and higher as your income goes higher. So you can, again, imagine if you're in a high-income situation, you probably have a pretty big IRA. Therefore, you probably have a pretty big required distribution. Therefore, you probably have more money than you probably need, and you are very charitable. So anything that you can do to give money away from your IRA is going to lower your income, and it might even do a great job of lowering your income below the Part B surcharge thresholds, all of a sudden saving you money. So not only have you saved money by lowering your income, you're saving money because you're avoiding a surcharge from Part B. So these are effects that can happen that are on top of the benefit of just lowering your income. The tax law has, I would describe these as little whack-a-mole features. You hit one thing, another thing pops up. You make too much money, another thing pops up. You smack this down, this goes down. There are lots and lots of interrelated situations in the tax law. And again, that benefits tax preparers, it benefits investment advisors to create such confusion and complication that you all just need a professional. Which is probably why they wrote the law the way they did. Okay, we're going to go through an example. And hopefully you guys can see these numbers. I've been criticized in the past for always talking about couples. So now I'm talking about a single person over the age of 70 and a half. For people out there who would care more about the joint filer situation, you'll get the concepts and you can sort of double the numbers. So we'll go through it step by step. So here we have a single guy, clearly, over the age of 70 and a half. So what does that mean? It means he's eligible to make qualified charitable distributions out of his IRA. QCDs is what the people in the industry call it. Qualified charitable distributions out of the IRA, and that will help satisfy his required distribution if he was born before July 1st, 1949. Otherwise, he can still do this. It's just that he doesn't have a required distribution. Okay? He's going to live, that person after that would live under the age 72 rule, but he can still do qualified charitable distributions out of his IRA. That's going to get really boring for me to say over and over for a long time, because people who are 71 are going to be living under this rule for a long time to come. Okay, let's go through the person's tax situation, their tax return from top to bottom. The first set of icons are working income, pension income, interest on their money, things that add into their tax picture. So non-Social Security non-required minimum distribution income. So everything else. Let's call it $20,000. That's how much is coming in from those sources. Then they have a required distribution from their IRA of $12,000. Then they have Social Security that they get, which is $20,000. And when I add up all of this income, and I go and check and see, well, how much is the government going to actually tax of their Social Security? Remember I talked to you about that concept of provisional income. So I did some math, and I calculated that actually this person isn't going to get taxed on their full Social Security benefit. They're going to get taxed on about 56% of their Social Security benefit. So just this yellow portion of $11,300 is taxable income on Social Security, their Social Security benefit. So they have $20,000 plus 12 plus 11,300. Now, that's the starting point. They then look at all of their deductions, their possible deductions, and we're going to do some nice, convenient hypothetical situation where we added up their mortgage interest, their property taxes, their state income taxes, and their health expenses, their out-of-pocket medical expenses, and it added up to be this very oddball $11,050 of stuff. They then gave charitable donations of $3,000 from their normal old checkbook. They wrote checks from their normal old checkbook of $3,000. So when you add up all of these pieces, it added up to $14,050. Okay. I created a small complication because I didn't mention it before, but when I showed you the standard deduction for a single person, and I said it was $12,800 or something close to that for a single person in 2020, in fact, the government says that if you're over the age of 65, we're going to add on to your standard deduction. We're going to actually give you $1,650 more for being over the age of 65 of a standard deduction. You do the math on that, I think. It turns out to be close to, let's just call it exactly $14,050. In other words, your itemized deductions, bing, 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 and bing, these 5 things, added up magically to be exactly what your standard deduction was. So you were going to get $14,050 no matter what, but you went through all the record keeping and figured out that, wow, I gave away just enough money to add on to all my other deductible expenses that I got $14,050. So when you do all of the tax calculation, $20,000 of income that doesn't come from Social Security or your IRA, your required distribution from your IRA, the taxable portion of your Social Security, minus the deductions that you added all up, you paid $3,313 of federal tax. Let's compare it now to a person who doesn't write charitable donations directly from their checkbook that's sitting in their normal bank, but instead use the charitable IRA concept. Going through the same exact example, $20,000 of every day of all income that doesn't come from Social Security or their IRA. Instead, up here, they write $3,000 worth of checks directly from their IRA. Not from the normal checkbook, but from their special IRA checkbook. Or they call their custodian and have the check sent. Whatever method, it comes out of the IRA. The government then says, fine, to satisfy the rest of your RMD, you can take out $9,000 to live off of. This adds up to be $12,000, which is what I told you his required distribution was. So we can check that off the list. He satisfied his required distribution, but he did it through a combination of taking money out to live off of and giving $3,000 additional from the IRA away to charity. His Social Security is still $20,000, but now the government says, well, it looks like you're poorer than you were before. It looks like you have less income than you had in the previous example. So now the government says, you know what? We're only going to tax 44% of this number. So now it's going to be a lower number of $8,750 of Social Security benefit that's taxed. So that gives you the idea of the whack-a-mole. We've just lowered our income by giving it away to charity from the IRA. Now the government says we're poorer. Well, isn't that lovely? Now we get taxed less on our Social Security. Now, you look at all the deductions, and you can see that without the $3,000 that he used to give, all of his itemized deductions didn't add up to be the standard level, the standard deduction. So now he gets just the standard deduction, which happens to be the same as what it was before when he added all the stuff up. When you do all this math, the tax bill became $2,647 for tax savings of $666. And what did he do to gain that lower tax bill of $666? He did one simple thing. He called his broker, he called his investment advisor, he called his custodian that holds the IRA and said, can you guys give me a checkbook or tell me how I can make direct charitable donations out of my IRA? And they said, sure, we'll send it to you. He set it aside on his desk, and whenever he was asked to give money away or decided to give money away, he wrote it from that checkbook and not from the one that was sitting at his bank for his bank account. That's the simplest habitual change you can make, and you can save money instantly by doing it. In this example, it's pretty clear. So, let me now segue into someone who is under the age of 70 and a half, because we have some here that are under 70 and a half, and there are people who will listen to this presentation and they'll say, well, that's great, but I'm like 3 years away from that, 5 years away from it, maybe even longer. What can I do? Because the tax law changed it to the level that's to the degree that said, you know what, you might not get a deduction for your charitable donations that you're making either. And I always say to people, giving money away should not be about the tax benefit, of course, but it's a nice add-on benefit if we can actually get a deduction. So in this situation, people under the age of 70 and a half, the trick is to bunch your donations. Bunching it means that consider putting multiple years' worth of donations into one tax year, and then taking a break of donations in the years that follow, and then in the subsequent 3-4 years in the future, do another bunch of donations. That has the effect, and I'm going to go through an example, that has the effect of allowing you to get a deduction for a good portion of your donations, then get the standard deduction in the future years, and then the 4th or 5th year out in the future, do another bunch, get a nice deduction for your donations. Not doing that allows you to get no benefit from now until the end of time, until you hit 70 and a half, where you can use the IRA as your tool. So bunching is a workaround, but that completely changes how you've normally been giving. You have to kind of think ahead, have enough cash flow to do it, have enough cash savings to do it, and to make that donation. So it doesn't work for everybody, but it's a tool. So let's go through a very simple example of a couple under the age of 70 and a half. Very simple setup, $95,000 of income from any source under the sun. They have itemized deductions that added up to be $20,800 outside of their charitable giving, and so we added on another $4,000 of charitable giving. It added up to be magically $24,800. That's their itemized deduction. It happens to also be their standard deduction just for being living human beings as a couple. You do all the math and it shows that they owe $8,036 of federal income tax. That's their situation, and they're giving away money, $4,000, that's their normal habit, and they're writing a check from their checkbook, their normal checkbook at their bank. The alternative is this. Same exact income, same exact level of non-charitable itemized deductions. And instead of just giving $4,000 every single year, they give 4 years worth in 1 year alone. So they put $16,000, they send $16,000 of charitable donations out the door. Their itemized deductions now become $36,800. That, by the way, is above the standard deduction that they were going to get just for breathing. You do all of that math, and it turns out that they get a tax savings of $1,440. And so what they've done is they've just thought ahead and said, you know what, we're going to give $16,000 over the next 4 years. Instead of doing it year by year by year by year, let's just give $16,000 away right now, and then we'll just take a break for 3 years. And they'll get tax savings for it because they bunched them together and they beat the system by going above their standard deduction. Now, I'm going to throw one last thing into the picture because most people would say, well, that's great, but I don't know if I want to give away $16,000 to charities this year. I like to think about what I'm doing, and I don't like to think 4 years ahead, and I don't necessarily want to throw that much money at a charity in the here and now. I certainly don't like also being the guy who says, no, 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 for 3 more years after this, because now I look pretty bad to my friends and family who want to have me to donate to their pet causes. So there's a way around it. And that's called a donor-advised fund. A donor-advised fund allows you essentially to create a nice little charitable envelope that allows you to bunch your donations in one tax year into the envelope, and then you have your donor-advised fund, your nice little envelope, where you can then piece it out in the future as you wish. You're advising where the money is going to go. It's no longer your money. It sits over at Vanguard. It sits over at Schwab. It's a donor-advised fund in your family name. It sounds very bourgeois, but it's very, very simple to set up. It does not have a high cost at all, and it allows you to piece the money out as you see fit. So you use that as your repository for your nice little bunched $16,000 of 4 years worth in one. I always say to people, you know, don't go crazy and do 10 years or do 15 years because you really can't tell what your life's going to be in 10 or 15 years. You may regret it because once this money goes into that nice little donor-advised fund envelope, or once you send off that money to the charity, it's no longer yours. So be reasonable. And I always say 3, 4, 5 years is probably reasonable enough because you don't know what the future is going to hold. So in this case, here's the structure. The donor gives money or securities. So if you happen to have securities that have gone up in value that you're eventually going to have to pay tax on, and you have a big gain, that's a great candidate for donating that. But giving money into the donor-advised fund, very simple to set up. Then from the donor-advised fund, you advise to give to this charity, this charity, this charity. You can give to as many charities as you want. You're essentially filling out a form with the brokerage firm, with the custodian, and you're sending it out to the donation, to the charitable entities of your choice. What do you get in return for that? Is you put the money in, it counts as a donation on your tax return. And you can put away significant amounts of money into a donor-advised fund and get that tax deduction. So this is the workaround for the problem of, I don't really want to give it all in 1 year and then say no, 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 no. I can say yes for the next 4 years, but I get my tax deduction in 1 calendar year.